Hey guys, welcome to today's OctaFX webinar. We are on the online workshop for complete beginners series, and this is the first episode. Today we're going to be talking about Forex Fundamentals, which is basically the basics, introduction to Forex. But before I go into the talking points of the webinar, I would like for you guys to type your name and where you're watching me from in the chat box or the comment section. So go ahead and type your name and where you're watching me from in the comment section. You can also go ahead to tell me if this is your first time. And my name is Ebuka Ambrose. Okay, let's look at the comment section. Ella from Port Harcourt, Nigeria, welcome. Becky, welcome. Chidera from Lagos. Yanga from South Africa. Yeboah from Ghana. Mandy from South Africa. Massive welcome to you guys for joining today. So I'll just quickly talk about the disclaimer. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation are provided as general market commentary and do not constitute investment advice. Trading is risky. So I'll go ahead to talk to you guys about amazing bonuses that you can get for taking part in this online workshop. And the first bonus is 100% single use deposit bonus per series. How do you get this? You sign up or confirm your participation on the OctaFX website. You watch all the webinars from the series, wait for an email from OctaFX confirming that your bonus is ready, initiate a new deposit request, and claim the bonus for this deposit. The bonus expires on the 3rd of August 2022. The second bonus that you get, second thing that you get for taking part or participating in the online workshop for complete beginners is a free trader's guide in PDF. How did you get this? You watch all the webinars from this series, you stay active, ask your questions in the chat or answer my questions, and you get your PDF handbook via email once the webinar is over. So just look back at the comments to see who has joined us today. Chomi from Port Harcourt, Benedict Victor from Delta, Becky from Lagos, Nigeria, Yax from Germany, Charles from Lagos, he says it's his first time, welcome. Olatunde from Oshun, he says he's new here, welcome. John Idiong from Akwa Ibom, new to Forex trading, welcome. Opeyemi from Oyo, Nigeria, massive welcome to you guys. So what are you going to learn today? What will you learn today? Like I said, we're talking about the Forex Fundamentals, introduction to trading. So you would learn what Forex is and how you can earn from it, liquidity and its importance in Forex, how a broker helps you enter the Forex market. We'll talk about currency pairs and quotes, and we'll also talk about volatility and its benefits, right? So this is going to be an interactive webinar where I look at the comment sections to get questions. So if on the course of this or in the course of this webinar you have questions, you can go ahead and ask your questions in the comments. I will be looking at the comments to check for questions and answer your questions. Okay, that being said, let's get right to it. So what is Forex, right? What is Forex? Before I go into the definition, Forex is an abbreviation for foreign exchange, right? Just you get Forex by taking the first 3 alphabets from foreign and the first 2 alphabets from exchange to get Forex, right? And the foreign exchange market, which is usually known as Forex or FX, is the largest financial market in the world with a $6.6 trillion day trading volume. What does this mean? This means that every day at least $6.6 trillion is being traded in the foreign exchange market globally, right? The foreign exchange market is a market where currencies are traded. Now, that huge $6.6 trillion covers the entire global foreign exchange market, but the spot markets, which is very important to currency traders, is at $2 trillion per day. Now, the foreign exchange market is open 24 hours a day and 5 days a week, from 5 p.m. Eastern Time on Sunday until 5 p.m. Eastern Time on Friday. So what you want to do is do a conversion of Eastern Time to your own time zone. For example, in Nigeria, 5 p.m. Eastern Time is currently 10 p.m. Eastern Time. Right? You also want to pay attention to daylight saving, which is when the clocks go forward 1 hour in the spring and back 1 hour in the fall, so that darkness falls at a later clock time. So just do your conversion to know what 5 p.m. Eastern Time would be in your own time zone. All right. So in simple terms, Forex involves trading one currency for another currency. Okay. So how can you earn in the foreign exchange market? How can you earn? This example is on a global scale. So we're going to look at this example and identify how you can earn from the foreign exchange market, right? So let's say the exchange rate for US dollar and the Nigerian naira is 410. What does this mean? You need 410 naira to get $1, right? That's the exchange rate. Now, to get $1,000 like you have here, to get $1,000, you would need to multiply that $1,000 that you need by the exchange rate. That's going to give you the amount of naira that you need to get $1,000, right? So let me take it again. The exchange rate is 410. This means that you need 410 naira to get $1. Now, in order to get $1,000, you're just going to multiply 1,000 by the exchange rate. In this case, we have 410,000 naira, which is what we're going to use to get $1,000 in this example. So let's say I've done the conversion, I get $1,000, and I hold on to this $1,000, right? And the economy of the United States is good, it's positive. The US dollar increases in value. Remember, you're trading currencies, so if the economy is good, it also has an impact on the domestic currency of that country, right? So let's say the US dollar increases in value relative to the Nigerian naira. This is going to cause the exchange rate to also increase, because now you need more naira to get $1. Why? Because the US dollar has increased in value. So if I decide to sell my $1,000, at the time of this increase, 485, then I would multiply my 1,000 by the exchange rate, which is 485, and I would be getting 485,000 naira. So for just holding on to $1,000, I have made a profit from the increase in the value of the US dollar, a profit of 75,000 naira. So this is how you can earn on the forex market on a global scale. I would also go into detailed explanation on how you can earn online trading the forex market by buying units of a currency, and this is why you need to always take part in the online workshop for complete beginner series, because that is what we are going to teach you guys. So an exchange rate is the relative price of two currencies from two different countries. In this example, we have two countries, right? And we also have two currencies, the USD and the NGN. So this is two countries and two different currencies. Now, the exchange rate is 410. The exchange rate also increased to 485 because the US dollar increased in value, right? Remember, the relative price of two currencies from two different countries. The objective of forex trading is to exchange one currency for another in the expectation that the price will change. More specifically, that the currency you bought will increase in value compared to the one that you sold. So this explains in simple terms the forex market and how you can earn on a global scale from the forex market. We're going to look at liquidity. This is a term that you would hear, or this is a term that you would see more often as you take on your journey as a beginner trader, you would come across liquidity more times, right? A lot of times. So what is liquidity and why is it an important feature in Forex? Now, liquidity refers to how quickly and at what cost one can sell an instrument. It could be a currency, it could be a commodity. Liquidity refers to how quickly and at what cost one can sell an instrument. It's basically a measure of how many buyers and sellers are present and whether transactions can take place easily. Now, the forex market is considered the most liquid market in the world due to the high volume and high frequency at which it is traded. And how do we calculate liquidity? So liquidity is usually calculated by taking the volume of trades or the volume of pending trades currently in the market, right? So in simple terms, liquidity just measures how many buyers and sellers are active in a market, right? So we have two types of liquidity. High liquidity and low liquidity. Now, high liquidity is when there is a significant level of trading activity and when there is both high supply and demand for an asset, as it is easier to find a buyer or a seller. While low liquidity is when there are only a few market participants trading infrequently, and it's also known as an illiquid market. Now, high liquidity means that there are a large number of orders to buy and sell in the market. So it's going to increase the probability that the highest price any buyer is happy to pay and the lowest price any seller is happy to accept will come close together, right? So high liquidity basically tells you that, wow, okay, the supply and demand for this asset or this currency is high, right? There are active market participants on this market. It's going to be easy for me to buy at any price. It's going to be easy for me to sell at any price, right? Now, for low liquidity, if you trade out of market hours, let's say towards the closing hours of, let's say, Friday, towards 9 p.m., 10 p.m., you would find out that there may be fewer market participants and liquidity would be much slower. Remember, high liquidity is when there is a significant level of trading. Also, when there is high supply and demand for an asset. If the market participants are much, if there's high supply and demand for an asset, you can identify that market to be a highly liquid market. And low liquid market is the opposite. Okay? Alright, so let us look at why liquidity is an important feature in Forex. Why is liquidity an important feature in Forex? The first importance is that a liquid market is associated with the other side of a given position, right? So it's not just about who is buying, it's also about who is selling and who is buying, right? Market liquidity is important for a lot of reasons, but basically because it impacts how quickly you can open and close positions, right? So you're buying, someone is selling, you're selling, someone is buying, right? The second importance is that in a liquid market, the bid offer spread will tighten, and in an illiquid market, the bid offer spread will widen. Now remember, illiquid is also referred to as a low liquid market. Okay, so in a highly liquid market or in a liquid market, a seller would quickly find a buyer without having to reduce the price of the asset to make it more attractive. And on the flip side, a buyer would not have to raise the price of the asset or raise the price to get what they want. The third importance is that liquidity tends to reduce the risk of slippage. It gives you faster execution of orders and tighten bid offer spread, right? So slippage is basically when you place an order in a certain place and the order doesn't execute at your preferred price, right? There could be a little slippage, right? So liquidity reduces the risk of slippage and gives you faster execution orders, in the sense that you're placing your order and it's executing instantly. That's an importance of liquidity. The most important thing to remember with liquidity is that the market liquidity is not fixed, right? It's dynamic. It's constantly shifting from high liquidity to low liquidity. So it's not always going to be a highly liquid market at all times. That's an important thing you should know about liquidity. Okay, so this explains liquidity and why liquidity is an important feature in Forex. We are going to talk about brokers in detail. Who is a broker? Now, a broker serves as the intermediary or the middleman between you as a trader and the Forex market. So Forex brokers are firms that gives you access to the foreign exchange market by providing a trading account for you. They also provide leverage and support functions to traders. So let me give you this example or this analogy. So let's say that I am a skilled footballer. I know how to play football very well. In order for me to play against the big clubs, in the Premier League or La Liga, these big teams, I can't just go by myself and decide to play against the whole club, right? I need to be signed under a club. Now, this club provides me with jerseys, shin guards, trainings that would equip me to play against these big teams in major leagues. That's basically what the broker does. Gives you access to the forex market, provides trading accounts for you, provides the prices of these assets for you, or the exchange rates of these assets for you, and also provide leverage and support functions to trader. Right now, how does a broker help you enter the forex market? So in order for a broker, or in order to find a buyer and seller of currencies, the broker is going to match you up with either a respective seller or a respective buyer, right? So how does a broker help you enter the forex market? They provide a trading account for you, provide fast trade execution, provide leverage, provide spread, and gives you deposit and withdrawal options, and also provide support functions for you, right? So OctaFX goes as far as providing educational resources, extra trading services, trading tools that would immerse you in a positive trading environment where you get to practice your skills with a demo account until you feel ready for live trading. So your broker actually plays an important part of your trading journey, right? And one of the things you can ask yourself when choosing a broker is, what are the varieties of assets I can trade? What are the varieties of instruments I can trade? How is the customer service? How fast can I deposit and withdraw? What is the spread condition? How is the regulations? Do they provide educational resources for me, or they just want me to trade? Do they actually care about me being a successful trader? These are things that you can ask yourself when making the choice of a broker. So this explains brokers in detail and how a broker helps you enter the foreign exchange market. Now we are going to look at currency pairs, which is also an important part of trading, because we're trading currencies, right? We're trading currencies. So currency pairs is an important part of trading. So what is a currency pair? I'm just going to look at the comment section, see if okay, no questions. All right, so what is a currency pair? A currency pair is the quotation of two different currencies with the value of one currency being quoted against the other. A currency pair is a quotation of two different currencies. So you have this currency and you have another currency. I would show you guys a graphical presentation or an image that explains what I'm trying to say. But yeah, let's get done with the definition. So the first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. So remember, it's made up of two currencies. The first currency in the currency pair is called the base currency, and the second currency is called the quote currency or the counter currency, right? Quote currency or counter currency. Now, a forex quote always consists of two currencies rather. A currency pair consisting of a base currency and a quote currency. Now, let me show you guys what I mean by base and quote currency. So we have this illustration right here. This illustration is that of Euro USD, Euro and the US dollar. Now remember, a currency pair is made up of two currencies. We have number one currency, which is the Euro. We have number two currency, which is the US dollar. And the first currency in a currency pair quotation is identified as the base currency. Now, the base currency is always greater than the quote currency, right? The base currency is always greater than the quote currency. Whatever trade that is being executed on a currency pair acts on the base currency, right? What do I mean? If we are looking at the currency pair right now, Euro USD, and I want to sell Euro USD, what am I doing? I am selling Euro to buy US dollar. If I decide to place a buy trade on the currency pair Euro USD, what am I doing? I am buying Euro to sell the US dollar. So whatever trade that is being executed, buy or a sell, you're acting on the base currency. If you're buying Euro to sell USD. If you're selling Euro to buy USD, right? I'm going to show you guys another graphical presentation or image on the currency pair Euro USD. So remember, first currency in the currency pair quotation is the base currency, usually greater than the quote currency. Now you're going to see some prices, right? Exchange rate. It's called exchange rate. Now what this means is that to get 1 euro, you're going to need this amount of US dollars, right? Remember the analogy or the example I gave on USD NGN, and the exchange rate was 410. What does that mean? That means that you need 410 naira, which was the base, the quote currency, right? Naira came second, USD came before NGN, and the exchange rate was 410. It's the same thing here with this 1.4745. So this means that you would need this amount, $1.47. You need this amount of US dollars to get 1 euro. So that is how the currency pair works, right? So you need 1.4746 to buy 1 euro. Okay, let me know if you guys understand in the comment section. Okay, beautiful. All right, so that explains a currency pair, which is made up of two currencies. We have the base, which comes first. We have the quote, which comes second. And remember that the base currency is usually greater than the quote currency. Okay. All right. So we're going to look at some major currency pairs in the foreign exchange market. And as beginner traders, it's important that you identify the major currency pairs in the foreign exchange market. So we have Euro USD, which is considered the most liquid currency pair in the world. We have GBP USD, which is the Great Britain pound against the US dollar. We have USD CHF US dollar against the Swiss franc. We have USD JPY, the US dollar against the Japanese yen. We have AUDUSD, which is the Australian dollar against the US dollar. We have NZD USD, which is the New Zealand dollar against the US dollar. And we have USD CAD, which is the US dollar against the Canadian dollars, right? So there are a lot of currency pairs you can trade from the market, but these are the major currency pairs that have been traded in the forex market. So what you can do as a trader or as a beginner trader is to focus on the currency pair and practice on that currency pair. You don't necessarily, it's going to be quite difficult for you to just trade all the currency pairs in the market. You can just streamline to a few and practice and learn how these currency pairs work. All right, so let's talk about volatility. Let's talk about volatility. What is volatility? Remember I said that liquidity is a term that you would see more often and hear more often as you take on your journey to be a trader. You would also see and hear much about volatility, right? So what is volatility? Volatility is the measure of the amount by which price fluctuates over a given period. Volatility is the measure of the amount by which price fluctuates over a given period. So if the market never moved, traders would not make money, right? So we need the market to move, we need the market to be volatile so that we can take advantage of the market's volatility and look for opportunities to buy and sell. Now, when a currency's price fluctuates wildly up and down, it is said to have high volatility. When the exchange rate fluctuates widely up and down, it is said to have high volatility. This can be caused by news that can affect the prices of an asset. Also, when a currency pair does not fluctuate as much, it is said to have low volatility. You can also find situations of low volatility when towards the end of the trading week on Friday at 10 p.m. Nigerian time or 5 p.m. EST Eastern time, 4 p.m. Eastern time, when traders and business hours or business workers are returning to or closing for the week, right? So you can the prices would not really fluctuate as much during that time compared to when business hours are up and running and news is being released, where you get to see wildly fluctuations of a currency's price. Okay, so how do you benefit from volatility, right? How do you benefit from volatility? The first step is to make sure that you're comfortable trading when volatility is high. Make sure that you're comfortable trading when volatility is high, right? So you don't need to rush when there is high volatility in the market or a currency. You see the prices move wildly up and down. That may not be a best time for you to go into the market, right? So if you want to profit from volatility, you have to make sure that you're comfortable trading when those prices are wildly fluctuating up and down. And the second step is to ensure that you recognize the potential for significant loss of capital and are prepared for this additional risk, right? So like I said about a volatile market, especially when the news is being released, or a few minutes or 1 hour after the news has been released, a high impact news, you see the prices just move wildly up and down. And so you need to ensure that you recognize the potential for significant loss of capital and you're prepared for that additional risk. You should also use solid risk management when trading a volatile market, right? You don't just want to open your trades without using a stop loss, or you don't want to open a trade without the use of a conservative lot size or position size, right? I would also explain these terms in the course of the online workshop for complete beginner series, so make sure that you don't miss any of these episodes. The third step is to focus on trending markets, right? You need to focus on trending markets if you want to benefit from volatility. So a trending market is a market that is moving in a direction, right? It could be trending upwards, it could be trending downwards, right? So you want to focus on trending markets. On the higher time frame, the trend is your friend until it bends. So the fourth step is to watch out for breakouts from consolidations, right? So what's a breakout? A breakout is basically when, or let me explain consolidation first and then I'll explain the breakout so you understand better, right? So a consolidation is when price makes a huge move and then consolidates at a point, just doesn't trend anymore, it just trades between the highs and the lows of that previous move. when the price is not just moving in one direction, it's just consolidating and bouncing up and down. So you want to watch out for breakouts of that consolidation to see if the market is going to break up or is going to break down, right? Another step or another way to benefit from volatility is to consider short-term strategies, right? Most especially when a news is being released. If you're not really sure of the direction, you don't just want to, look in the long term when the market is volatile and hasn't revealed its real or continuous direction or reversal direction. And the last way to benefit from volatility is when in doubt, wait it out. What do we mean? You're not going to force a trade, you're not going to force the market to move in your direction, right? So if you're in doubt, if you're not sure of your entries, if you're not sure of your strategies, if you're not sure of what you see in the market at a certain time, you can just wait it out. There would always be opportunities for you to trade, right? There would always be opportunities for you to come to the market with confidence and trade, right? So if you're not sure at a certain time, you can just wait it out. Okay. All right. So you're not going to lose money if you don't trade, right? So if you have a trading account and you're not sure about trading, you're not going to lose any money if you don't place that trade at that time. So you can just wait it out. Okay, so that explains volatility and a few ways that you can benefit from volatility. It's very important to note how volatile a currency pair is before opening a trade, right? And before attempting to trade in volatile markets, make sure that you are mentally and tactically prepared to manage the risk involved. Okay, and also make sure that you use proper risk management. So that's it on the Forex fundamentals. This is like an introduction to Forex. I would take your questions now. So if you have questions, you can go ahead and ask your questions in the comment section. And I'll be looking at the comment section right now to take your questions. Yeah, so if you have questions, you can go ahead and ask your questions in the comment section. Omoyele says, I like the part where you said, when in doubt, wait. That's one of my major challenges. I just wanted to trade even when I can't see anything. Yeah, it's important that you're patient. Patience is a skill that you must master as a trader, right? So if you're not sure of what you see, you can just wait. You're not going to force the market to move in your direction, right? So you can just wait till you're confident to take a trade and always use proper risk management. Will this video be available for late? Yes, you can always come back to watch this video on the OctaFX YouTube channel. How can I start? There's a link in the description that says start trading. So you click on the link and you create a trading account. You can start with the demo account if you want to practice, get confidence, and get that comfortability to trade on a live account. How can we make money on demo account trading? No, you can't. No, you can't. A demo account is a demo account. It's like a prop account. It's for practicing. So you want to make money without money. You can't make money in a demo account. It's for you to practice, learn strategies, refine your entries and exit points, understand what works for you, what doesn't work for you, so that you can get the confidence to go trade on a live account. which currency pairs would be the best to start with? You can look at the major currency pairs that I showed you: Euro USD, USD JPY, NZD USD, AUD USD, USD CAD. Just look at the charts of these currency pairs and practice and identify which one works best for you, right? But as a beginner trader, you need to focus more on the major pairs because they are highly liquid and also volatile. Does OctaFX trade commodities as well, like gold? Yes, OctaFX, you can trade gold with OctaFX. Okay, going to take one last question. Okay. Oh, to understand liquidity, you can just come back to this video and watch where I explained about liquidity. But it's basically the measure of buyers and sellers active in the market, right? Just quickly explain that for you. Yeah, so I'm just gonna go straight to the brain test. We'll talk about spread and pips in subsequent online workshop for beginners episodes, which is why you should not miss the next episodes of the online workshop for complete beginners. But right now, we are going to do a brain test, right? I need to be sure that you understand what you've learned today. So let's do a quick brain test. You can go ahead and answer the questions in the comments or the chat box. I'll be looking right now to see your answers. So the first question is, the forex market is open 24 hours a day and how many days a week? The forex market is open 24 hours a day and how many days a week? Go ahead and answer the question in the comment section. The forex market is open 24 hours a day and how many days a week? Five days a week. Alia says 5 days a week. Yeboah says 5 days a week. Be Glad says 6 days a week. Lawal says 5 days a week. Well, the correct answer is 5 days a week. The forex market is open 24 hours a day, 5 days a week, from 5 p.m. Eastern Time on Sunday to 5 p.m. Eastern Time on Friday. So you can just do the conversion to know when it opens and closes in your own time zone. Second question is, how many currencies make up a forex quote? How many currencies make up a forex quote? How many currencies make up a forex quote? Arinze says 2 currencies. Yeboah says 2 currencies. Frimpong says 2 currencies. James says 2 currencies. Eben says 2 currencies. Thompson says 2 currencies. 2 currencies is correct. 2 currencies make up a forex quote. A forex quote is also known as a currency pair. Just like your pair of shoes, right? You need your left foot and your right foot to make up a pair of shoes. So the last question is, EUROJPY, AUDJPY, and CHFJPY are all major currencies, true or false? EUROJPY, which is euro and the Japanese yen, AUDJPY, Australian dollar and Japanese yen, and CHFJPY, which is the Swiss franc and the Japanese yen, are all major currencies, true or false? James says true, Arinza says true, William says true, Uja says false, Onyeka says false, Chigozie says, oh, okay, he's answering for number one, but he's correct anyway. Emeka says true, Yax says true, Samson says true, Leke says false. Okay, so the correct answer is false, right? I identified the major currencies in the foreign exchange market, so you can go back and watch that, or you can come back to this video and watch to identify the major currencies in the foreign exchange market: Euro USD, NZD USD, USD JPY, and all that. Okay, so it was an amazing webinar with every one of you. We are on the first episode of the online workshop for complete beginner series, and I'm just going to go straight to talk about what we have for the second episode. Guys, we really have amazing topics for you. We're going to talk about a lot of things: pips, spreads. I know you have questions, and you're just curious to know more about the foreign exchange market, which is why you shouldn't miss the second episode, where we talk about first steps in forex. First steps in forex. We're going to look at buy and sell orders. We're going to look at margin. We're going to look at how to calculate your equity. We're also going to look at line and candlestick charts. We are also going to look at spread. Okay, so that's what we have for the next episode of the online workshop for complete beginner series. If you asked some questions in the comments and I didn't see those questions, or if you have some questions right now that I did not see, you can still go ahead and answer the questions in the comments. I would answer those questions in the next episode.